Sup, freaks? It's your boy Marty here to introduce this rip of TFTC. Thank you for joining us. Give this video a like. Subscribe to the channel. If you catch us on podcast apps, make sure you subscribe there. Give us a rating, a review. Go to tftc.io as well. Become a member of the site. Join the conversation. Truth for the commoner, trying to get you the high signal content in a world gone mad. This rip was brought to you by our good friends at River. River's here to make it as easy as possible for you to buy Bitcoin and then take it into self-custody. Go to river.com/TFTC, set up an account today, and you'll get $5 of Bitcoin after you buy $100 worth of Bitcoin on River. You can dollar cost average into Bitcoin with no fees. If you're just buying one off, River has the best fees in the industry. They back all their Bitcoin reserves 1-to-1 in multi-sig cold storage. They highly recommend that you take self-custody. They just introduced limits. So if you want to set a limit order below or above the current Bitcoin price, River makes that extremely easy as well. They also have real customer support. You can pick up the phone and call them if you have any questions about your experience on River. So go to river.com/TFTC, set up an account today. Enjoy this rip. Mic check, 1 2 1 2. Jamie, we're live.
Microphone check.
Jamie, conversing with our Jamie Logan.
Great. Great to be here. Thank you for having me.
It's a long time coming.
It is a long time coming. I've been wondering, when am I going to get on the show? But we had a good riff on the Peter McCormack show.
That was a great conversation. I was with Thomas over the weekend.
Yes.
And we were reminiscing on that conversation. It was great, free flowing.
God bless PubKey.
God bless PubKey. God bless America. God bless Bitcoin. We might hit 50K during this episode, during this recording.
Yeah. Well, we are over $1 trillion market cap officially, which is exciting.
1T.
1T. Deleting a zero, as they say, or adding a zero.
Adding a zero.
Adding a zero.
Yes.
Right.
It's pretty crazy. It's happening rather quickly.
It is, yeah. I think maybe we all may have underestimated the passive allocation machine of American public markets.
Did you underestimate it yourself?
I did not. I deal with I have a lot of older friends, and I think that one thing that Bitcoiners underestimate is the technical hurdle of not so much learning Bitcoin and setting up a Bitcoin wallet, but the fear of that an older person thinks with regard to anything about a computer. I mean, how many kids, friends that have to help their parents with their email every time they come home, or get asked to solve a remedial computer issue, and the one characteristic of it is the uncertainty that they have around what happens if I click this button. There's like this fear that if I click this button, my whole email's going to get deleted.
It's like that meme where the dude drags off his files to the trash can and his computer just evaporates in front of him.
Yeah, exactly. That's a real technical hurdle.
And how many of these our elders do you know that when you go to help them with their email, they have their password on a Post-it note right on their screen?
Yes.
Think of Bitcoin. It's like, oh yeah, here's my private key. It's right here.
Like the villain Nolan Sorrento in Ready Player One.
I watched that Thursday night.
And his password is Bossman69. And it's written on a Post-it note right next to the...
I didn't get through the whole movie, but I watched like the first half before falling asleep. It's a good one.
Yeah, you probably missed the part I'm referencing where they hack his...
I've seen it before. I was rewatching it.
Okay, so yeah. I've seen it like 25 times.
Yeah, it's very Bitcoin-esque in a way.
Prescient. There's a scene when they're doing an opening montage describing the success of this VR AR platform, and there's a currency, a digitally native currency within the world, and I forget what the news clip says, but it's some kind of milestone that the the market capitalization of the in-game currency has exceeded a crazy value. Yeah.
The winnings for that tournament in Ready Player One, if you get all the keys, $1 trillion in stock.
Yeah, half a trillion.
Half a trillion?
Yeah, because he says, I've seen it a lot. He says half a trillion dollars.
Yeah,
which it's 2035. That is way low,
considering all the inflation that we're gonna.
Yeah. I mean, it's gonna be like $50 trillion if it were realistic.
Yeah.
But the movie is based on a book that I think is 15 years old, before M2 growth really, really started accelerating and compounding.
Yeah. Do you think that's why the price is pumping right now? Because people are looking out at the world and they're going to have to print a shit ton more money? Or is it simply flows?
I think it's flows. I think that China, I've been hearing a lot about the China situation. The Chinese stock market is cratering. They're so indebted and their economy is stalling. And so the China print
is coming.
It's big. Yeah.
And people are successfully escaping yuan and Chinese stock markets into Bitcoin, despite the fact that China does not like Bitcoin.
Yeah. There's probably a lot of that is flowing through the Texas electricity market through hosting contracts. Because I think that is a loophole that works, is if you buy an ASIC in China, send it anywhere else and run it, and then pay a services contract in renminbi, you're effectively circumventing the capital control.
Yes. And acquiring Bitcoin.
Yeah.
On the back end. Let's talk about this, because this is a big theme in the space right now. I think everybody in the mining industry knows there's a bunch of Chinese that are either hosting with American companies or mining themselves. The media is beginning to portray this as a systemic risk to the American economy potentially, but more specifically the American grid system. Are the Chinese attacking our grids?
That media, they have such a wonderful imagination, don't they? Yeah, it's there's no grid attack. I mean, we know some of these firms personally. We know their leadership. Their leadership is American. They're extremely sensitive to political risk. They're terrified. These are people who were or are citizens of China under that quasi-authoritarian regime. They're very inherently scared and skeptical of government. And so they are doing everything they can to be compliant. The one thing I would say that is the most interesting and probably the least enduring component of this phenomenon with Chinese-owned ASICs being operated at American-operated facilities. Just for starters, the high voltage infrastructure that's connected to the power grid is owned and operated by an American firm. And then you are prohibited under Texas law to own and operate high voltage infrastructure in a Chinese controlled entity. So it's called the Lone Star Infrastructure Act. So that on its face is illegal for anything like that. So there's no Chinese nationals who have the ability to destroy the power grid. They also would not want to, because that's their Bitcoin printing, capital control, circumventing machine. The one thing that's strange about their behavior is they do not perform economic curtailment as a profit maximizing miner like Cormint. Cormint's our Bitcoin mining company. We are a profit maximizing entity. We are never attempting to consume electricity that exceeds the $1 per megawatt hour equivalent of our Bitcoin mine for any period. And so last year, just by the numbers, we were running 30-ish joules per terahash fleet. That meant that in the west zone of ERCOT, we were online 90% of the year, and we were offline 10% of the year. And it's not exactly perfect because we avoided some of the 4 coincident peaks to reduce transmission costs. So it wasn't always economically perfect, but it's a rough estimate of how many hours of the year, 90% of the hours of the year, you could profitably convert electricity in the Texas wholesale market into Bitcoin. 10% of the hours of the year you couldn't. The peer group of other miners within Texas is not economically perfect. They are willing to overpay for power just to convert that into Bitcoin, which is really kind of a unique market dynamic. It is not an economically rational market because the desire to circumvent capital controls and save in Bitcoin creates a slight premium on power. I do think it's going to go away because it doesn't make any sense. But yeah, that's one kind of interesting phenomenon.
So does it have to do with the capital controls? The reason for them doing this, because they're afraid that if they were to sell that electricity for dollars and then have to convert it to Bitcoin and run into some problems trying to convert that?
I think it comes from a bunch of potential factors. The default hosting agreement template is a 95% uptime agreement. And so there's some economic imperfection in that. That means that the miner who is hosted is paying more for electricity than they should, and the host is leaving money on the table. What in our view looks like a perfect hosting agreement is one that is constantly optimizing between the two and sharing the revenue between the host and the miner. There's not a bunch of Chinese guys who are sort of watching Load Zone West real-time settlement in ERCOT. But their host is, and if the contract were structured in such a way that the host would optimize between the two and always just settle the difference in Bitcoin, then that would be the economically perfect outcome. But the industry has not progressed to having a creative profit maximizing hosting agreement. And it does add some complexity. It adds some trust. There's some fidelity on doing settlement reconciliation for an ERCOT bill, which is an additional incremental overhead for the accounting departments. So I'm confident it's going to change, but the current state of it is not optimized.
But it's become more optimized over the last 5 years. It seems like there's been this progression of miners making mistakes around the power purchase agreements, learning from those mistakes, getting better PPAs. Mm-hmm. Now with ERCOT and miners becoming more immersed within demand response programs, we've had a bit of trial and error over the last 3 years specifically with that, and people are getting smarter, and it seems like slowly but surely over time the industry is going through this iterative process of figuring out what is the ideal situation, from locking down the power to setting up the hosting agreement to then doing that profit share on top of that.
Definitely. And there's been attrition of less efficient operators. And we had major Texas operator, Compute North,
just talking about them,
lose their business to their lender. And it was being operated by USBTC for a while, who bought it, who partnered with the lender, I think, to attempt to recover some of the assets. And now that portfolio has transitioned to Marathon. So Marathon acquired the Compute North built assets. Celsius is another one. Celsius actually, I am good friends with the guy who was running the Celsius fleet, and they were actually good from an energy management perspective, but they had a critical flaw in their capital market structure, obviously.
And the business model, the other part of their business wasn't.
Yeah, I mean, that's what I mean. They were running an ongoing fraud and had an asset and liability duration mismatch. So they, not necessarily an inefficient operator from the mining perspective, but a fraud.
Yeah.
So it's getting better. It's getting better. And I tweeted yesterday, the addition of a base load consumer that is never contributing to peak demand periods on the grid is literally the ideal consumer that you can add for the health of a power market in a power grid. There's no better consumer. It's the inverse of a retail consumer, which around the steady state most of the year, the ERCOT power grid demands between 40 and 50,000 megawatts of power. And last summer, record hot summer, peak demand was 83,000 megawatts, plus or minus a little bit. So you're talking about a 2x response from the generation fleet on the grid to be able to serve those customers. And the more Bitcoin mining baseload that is building and coming online here, the stronger a signal it sends to the generation community to invest here and commit to power generation resources. And then that Bitcoin mining load is completely gone during the peaks. So you get this great signal to the generator community, hey, come and build a power plant here. Build your solar farms, build your wind farms, build your natural gas plants. And then that demand is there 90% of the year if it's economically perfect, and it's gone the 10% of the year when the residential community needs it.
Do you see a scenario where we build generation capacity to, let's say, like 100 gigawatts, like far beyond whatever peak demand would be in the middle of summer, middle of winter, if we get bad winter storms here, and Bitcoin miners just soak up the excess capacity into perpetuity? That is maybe my naive brain. That's like what I think should happen.
No, I think you're thinking about it from like a very first principles. It may be a naive analysis, but it's first principles, and it's correct. It is absolutely correct that, especially with the market distorting price signal of the renewable energy production tax credit.
I wrote about this over the weekend.
It's just like you can underwrite. So a wind farm, here's an example. A wind farm has a capacity factor of about 30 to 35% of its nameplate output per year. What that means is you build a 1 megawatt wind turbine, you will get 35% of the year of wind that is sufficient to create generation for that. So there's 8,760 hours in a year. You get about a third of that. So call it a little less than 3,000 megawatts per year. 3,000 megawatt hours per year of generation will come from that wind farm. That 1 megawatt wind turbine costs $1 million to build, rough estimates. The production tax credit will give you around $30 a megawatt hour for every megawatt hour that you generate. So that's 3,000 megawatt, and the production tax credit lasts 10 years from when you build. So it's 3,000 megawatt hours per year times 10 years, 30,000 megawatt hours times $30 a megawatt hour in production tax credit. It's $1 million exactly. So you could literally make $0 from selling energy, and you will pay for the wind turbine. Yeah. And that is what is happening. This is why we have 10% of the year there's negatively priced power in ERCOT. And even though wind farms are not generating any revenue from selling energy, they're still building them because the federal government is effectively subsidizing this power. I mean, Cormint's Bitcoin mine is a decommissioned wind farm that decommissioned in its 12th year of operation, because once the production tax credits ended, they were never making money. So they had no use for it. They were losing money.
I want to dive deeper into this topic. Before we do that, like, why was Cormint positioned to come take this asset and make it profitable? What do you do that makes this now profitable?
Yeah, well, I mean, we're effectively the inverse of market distorted price signal from renewable energy. We are there to consume power when there is no demand from the grid, and then we are shutting off. Our behavior is as close to economically perfect as possible. And that's the business is attempting to be as economically perfect in consumption of power as we can be. And the big barrier to entry for a mining startup, at least if you want to play on grid and wholesale, I mean, you know off grid better than anybody, so you know the constraints there are, generator finance and all of that stuff. For on grid, it's a substation and interconnection. The interconnection queue in Texas is 2 to 4 years, depending on where you're trying to go online, and the long lead time items on a high voltage grid interconnected substation are 1 year at best, 4 years at worst, and you're talking about making somewhere between $5 and $20 million of capex before you even mine a Bitcoin. So you're waiting 1 to 4 years and making $5 to $20 million of capex to be able to mine Bitcoin. It's extremely, if you're a startup company, that's, and most investors who invest in a Bitcoin mining startup, they would like to participate in the price appreciation of Bitcoin. And if you do not deliver that, they are not pleased with you as a fiduciary of their capital. So you've got to convince someone to give you enough equity at a valuation that still makes sense for you, or to give you an infrastructure loan to go and build a substation to make that happen. We were in that phase of our business. We began our operations in upstate New York, and we concluded not a great place to do anything related to Bitcoin, much less be a Bitcoin miner. And we did a nationwide search of the best place to do it. We identified West Texas, and then we found a wind farm owner who was very motivated to sell their assets because they were actively losing money on it. And we proved that we could develop the infrastructure to do this, and we had a team who was going to figure out ways to innovate in this industry, and we convinced them to sell us their substation and transmission line from their wind farm as an equity round in our business. So we actually took a substation and a transmission line in kind as an equity contribution to the company, and that was a game changer. I mean, that's the reason why we exist today.
And that's a very creative way of doing a deal.
Right. Creative. We had to convince people, and the deal had so much hair on it that it was, there was virtually no other use for it. We had to renegotiate 3 ground leases, a joint ownership of the transmission line, an electricity supply agreement with the utility and a cooperative, transmission studies with ERCOT. We basically had to do 6 or 7 transactions successfully in order to do this. So the previous owner realized how daunting it was for someone to buy this asset and how much hair there was on the deal. And we were able to negotiate favorable terms that were effectively like, look, this is going to be really hard to do, and we'll pay you some money for just the option to let us try. So we paid them $1 million at the close of the deal. And then upon the successful completion of these 6 or 7 agreements, the transaction became structured as a little bit more in cash and mostly equity in the company. So they're the second largest investor in our company. And I believe we will deliver them a great return over the long run on this wind farm that was effectively junk. And they have a chance to turn trash into treasure through this company.
Well, that's why it's creative in 2 ways. Number one, just the pure structuring of the deal. Basically acquire these assets in a smart way, in a capital efficient way that allows you to operate very profitably and get a payback on your initial investment quicker than you otherwise would have. And then 2, now that they're the second largest equity holder in your company, you have to I imagine, you probably know, you definitely know better than I do, but if they're building wind farms, they understand the economic issues that these type of projects have. Now that they're an investor and seeing what you guys are doing, like, oh shit, this is a solution to this massive problem that exists. Is that happening?
It's happening gradually. Mm-hmm. And across the spectrum of large institutional power market firms, you've got a huge range of Bitcoin acceptance and Bitcoin bullishness and orange pilling. I'm surprised at how low it seems to be to me now, especially because Bitcoin mining loads can really add a lot of value to generation fleets. One of the biggest problems in generation fleets is the forward power market in ERCOT right now is trading about $55 a megawatt hour for the next year. It goes down a little bit the further that you go out, and natural gas is very cheap. Natural gas power plants have a healthy operating margin if they can secure a long-term gas supply that's cheap and run it through a natural gas plant. Obviously, wind and solar have no input fuel, so it's even a stronger value prop for them because they have no sensitivity to a fuel input cost. The big boogeyman in the power market is that the volatility distribution of power prices in ERCOT is so large right now, and it's growing because if you're a generator in this grid, you're absorbing power prices that go down to -20 for the chance to get power prices that go up to positive 5,000 per megawatt hour. And if you are a gas plant and you say, okay, I'm going to hedge a year of power because sure, it's going to be -20, it's going to be 5,000. I just want to lock that in and sell for $55. It's very hard for you to structure what's called a unit contingent hedge, which means as long as my power plant is operating normally and it doesn't have a catastrophic maintenance issue, then you buyer of this offtake agreement from me, you will get your power. But if something happens to my plant, you're not going to get your power. From what I understand, the buyers are more and more reluctant to do unit contingent deals that only deliver the power when the power plant is operational. And what that looks like basically is if something happens with the power plant during the summer when it's the hottest, you're more likely to have maintenance issues when you're running your plant really hard and it's very, very hot. If you sell that hedge and your power plant goes offline, you're short power. You're short power to the market. And that opens you up to catastrophic risk as a company. If you put a Bitcoin mining load there, even with crappy equipment, I mean, you could put S19s there or S9s there. Then you don't need to hedge because you're selling electricity to the Bitcoin protocol at, let's say the worst machines on the market is the M30S. It makes about $85 a megawatt hour. The best machine is the S21. You're making just under $200 a megawatt hour. You've got a PPA with the Bitcoin network. It's a variable price PPA and it's volatile, but you've got a PPA with the Bitcoin network and you have a computing fleet that can power down 95% of its load in 3 seconds in response to prices. So you would be able to keep your generation fleet running. If your generator goes down, you just optimize the Bitcoin load against the real-time market. You already have that behavior there, but you then are gaining a call option where if your generation fleet is running and power prices go up, then you can deliver that power back to the grid and make a lot of money there. And so it's a very appealing proposition from the perspective of a power market operator, power generation operation fleet. It's just that they're not there. I think that some of the bankruptcies, especially some of the early movers, the more open-minded Bitcoin believers in the power industry, they invested in some of these firms that had very bad outcomes in 2022, and that scared people off because there's just a ton of career risk for the junior guy at XYZ Energy Co. who's like, yeah, we're gonna go Bitcoin, we're gonna do this, we're gonna do a Series B, and we're gonna sell a PPA to these guys and this optimization deal, and next thing you know, you're in a bankruptcy court for 2 years, and your CEO and your legal team are like, this guy's a joker, and that's
we're not touching this.
We're not touching this. Yeah. It's gonna have to be built bottom up. it's going to have to be built by, in my opinion, by Bitcoin firms who already have Bitcoin risk. Like we're wearing Bitcoin risk every single place in our business. There's no incremental risk to us to go into power generation, other than the operating risks of power generation, which are numerous and could easily destroy our company.
At that point, in for a penny, in for a pound. It's
right. We're not adding an incremental existential risk or career risk. It's already a risk that we're wearing, and we know we're going to consume power. I mean, that's the most consistent part of our business is we will consume power.
Yeah. And then bringing this back to the renewable energy credits, and particularly focusing on reliable hydrocarbon and nuclear. Nuclear they're not able to take.
They are now.
They are now? Okay, now they are. That's good.
Biden threw him a bone.
Okay, that's good. It's good to hear that. But honing in on natural gas and coal facilities that aren't able to reap the benefits of these credits, that's the thread I wrote over the weekend. I was at an event in Palm Beach on Saturday, and there was a panel talking about the quote-unquote climate crisis and energy markets. And this is the question I brought up, just knowing what we've seen in the Bitcoin mining industry is the renewable energy credits have created such a distortion in the pricing mechanism of the market that it is impossible to spin up new reliable generation. Not impossible, but very hard, because you have the material amount of times with negative pricing that really eats into the economic models of these reliable generation sources. And then it's if you're not going to decommission these reliable sources via mandate, you just decommission them by distorting pricing mechanisms. And that's happening as well, where you have reliable sources that are up and running, but they have to decommission themselves because they're not economically viable. And I think it is imperative that the reliable generation sources that do not have the benefit of the RECs that are out there really figure out a Bitcoin strategy, because that is the only way that they're going to stay viable as long as these credits exist.
Absolutely, yeah. And I wrote in response to the winter storm that we had here from polar vortex in January, I wrote a big tweet thread about this, which is that, I mean, if you look at what's happening here, so Texas is the second fastest or the fastest, I believe it is the fastest as of this year, the fastest growing renewable energy grid in America by volume. It's the number one wind state. It's going to be the number one solar state. And West Zone, a lot of this is going in West Texas. West Zone is 92% renewable installation by nameplate capacity. So this is like the grid of the future over there in West Texas, which is somewhat ironic given that it's a major hydrocarbon economy, but it is effectively the grid of the future over there. So if you want to see what these utopian grid of the future ideas look like with all intermittent renewables, you just go look at West Texas and you can see what happens. There's some system reliability issues because there's not as much inertia and rotating mass on the grid as when you have a bunch of coal plants and nuclear plants and combined cycle plants. So you have a generation fleet that's more sensitive to a voltage issue somewhere else on the grid, meaning you could have cascading trips of multiple generators and then they trip off multiple loads, and you could have blackouts with these largely renewable grids. You also have higher prices on average. You have lower prices for 90% of the year, but the remaining 10% of the year is actually pushing prices up with the same gas prices that we had 2 or 3 years ago. You know, if you exclude the Ukraine invasion when gas went to $10, the same natural gas, just to be clear, you have roughly the same gas price environment. The forward curve of power is twice as expensive, and it's all coming from the shoulder hour volatility when there's no solar and the wind hasn't picked up yet. And so people are paying more for power and they get a less reliable transmission grid. So it is like this, the fastest growing renewable energy grids. I don't think that people who live in them understand that we are voluntarily degrading our standard of energy availability from a very first world standard to closer to a second world standard. And at the same time, we are paying more for a less reliable product. And that's just facts. I mean, it would be great if we could transition to a future where we harness the power of the sun via wind speeds and photovoltaic energy generation to power our species. But this transition right now, if you look at the early stages of it, it's like people are making a bad trade here. They're paying more for a worse product. And at the same time, the federal government is going further and further into debt to effectively subsidize this dereliabilitizing process of the power grid.
Well, and going back to like the voltage synchronization, and I learned Steve Koonin was at this event. He was explaining this over the weekend, where basically with a natural gas plant, a nuclear plant, a coal plant, within the turbines, they can synchronize like the push and pull through the transmission lines, where that does not exist for wind and solar, which is it introduces this destabilizing effect that could lead to these rolling blackouts, correct?
Right, yeah. It's called voltage ride-through. Effectively, gas and anything that has a turbine, that has this rotating mass that is being used to generate electricity, any turbine mechanism, the more rotating mass and inertia you have on a power grid, the right way to think about it is like it's like pressure in your tires. You hit a little bump in the road and you don't feel it. With inverter-based renewables, wind and solar, you lose that inertia, and you lose. It's like your tire becomes slightly deflated, so you're gonna feel a bit more shock. And then, just to continue the busted ass analogy, if it works or not, it's like you hit a bump that's big enough, and the bump actually hits your hubcap, and it hits your wheel axle, or whatever the appropriate automotive part is, and it dents it, and it knocks your car's alignment off. In this case, it's you have one piece of the system trips, and the sensitivity of the other pieces of the system will then trip in response to that. And they can solve it. The solution is that the utilities need to upgrade different hubs, different big substations or connection points within the system with shock absorbing equipment, and that then gets added into the transmission charges that consumers pay the next year. And so you have to have beefier transmission infrastructure to be able to absorb all of these shocks. And it's another way that costs go up. It's just not energy costs, it's transmission costs in that case.
Yeah. And so in your mind, what is the ideal mix of these unreliable generation sources and reliable generation sources?
I see both sides, where if you can get the cost of solar and batteries and wind low enough, and subsidies push that demand to drive innovation in that, and you upgrade the grid, you do end up having a lower cost of electricity because you're not relying on fuels. So you can see that it is utopian. It's far away. It's extremely difficult to understand if you have a constrained economic view. So just as an example, right now, because of the amount of solar that's currently installed in West Texas and the amount that is coming in West Texas, and so if we say West Texas is the grid of the future, let's look what this market looks like. There's nobody who will buy a power purchase agreement from a solar plant in West Texas. And so you can't get that project financed anymore. So we're hitting a wall in terms of the willingness of financial market counterparties and lenders to purchase this power for a term that is sufficient to underwrite the lender on it. So that means someone's got to put equity to build a solar plant, and no one's going to do that because you're just giving up a cash return for a fixed return. It just doesn't make sense to do that. And through that and a number of other constraints, including grid volatility, battery economic viability, and we could spend 30 minutes just talking about this. It's really hard to see how we get there without having a centrally planned economy that's extremely inefficient for a while. It's already somewhat inefficient. We have this distorting signal of production tax credits. It's hard to see how we get there using our market economy. I think they should give nuclear a $50 production tax credit. They should give nuclear a $50 production tax credit. The government should subsidize the storage and removal of nuclear waste. And we can decarbonize our grid, since that's what a good percentage of the American people want and vote for, by building nuclear plants. And there's so much innovation with fission. You have small modular reactors, molten salt reactors. You have really good fission technologies that are much safer than the historical fission reactors that have melted down a few times in other places. And France, for all the things that that they may not be the best at, like winning wars or whatnot, they are great at nuclear. They have a great nuclear industry. They don't have a history of accidents, and the French government subsidizes the removal and storage of nuclear waste. And now they're one of the best performing European economies in response to the shortage of gas and having to import all this LNG and having those pipelines cut off from Russia. The French economy, from an electricity standpoint, is doing great because they rely on nuclear. And if you look at the carbon footprint of the French power grid versus the German power grid, now that Germany has decommissioned its nuke plants, is relying on tons of wind and tons of solar, and then lost its access to natural gas, they're burning wood pellets over there. They're burning wood pellets.
They're cutting down forests in North Carolina, and we're shipping over wood pellets so that they can power their economy in Germany.
Exactly. And they're paying more for power, and they're emitting more carbon than they were before. And it's extremely ironic that the German Green Party is so dumb. And they did suffer a bunch of defeat in recent elections, so the German people are
waking up.
They're waking up. They're picking up on this being just really bad, illogical policy. But
they're losing major incumbent industry that's been around for well over a century. BASF is moving out. Some of the car manufacturers are moving out. They're like, it's too expensive. I can't do it here anymore.
And that should be scary for the world. Historically, a weak German economy has not led to good things.
It is insane how we've gotten to this point. Because I wrote the piece in the Bitcoin Times Energy Edition, and I focused on Germany. And it is insane what they did over the first 2 decades of the century. Like in 2002, their overall generation capacity was 115 gigawatts. 84% of it was nuclear, coal, nat gas. Mm-hmm. Since then, they've expanded their generation capacity by more than 2x to 240 gigawatts. And the percentage of those 3 reliable sources of overall generation capacity is 34%. They decommissioned more than 20 gigawatts of nuclear power.
That was
over
crazy.
That time.
I mean, it's a real head scratcher.
Yeah, and that's really the question there, because like you'd think you more than double capacity. People look at that like, oh, that's awesome. But over that same time period, the amount of terawatt hours produced in 2002 versus 2021, which is when I ran the analysis to, fell by 2%.
Yeah.
And it went from like 53 terawatt hours a year to 51 point something.
Right.
And then the price of electricity for your average 3-person German household went up 187%.
Yeah.
Over that time period. And I think that is the perfect case study that anybody in the world deploying an energy policy needs to look at and say, I get everybody wants to decarbonize. I personally don't think that is what we should be doing. I think the carbon hysteria is just that, a hysteria, fear-mongering campaign. I think we should be as efficient as possible, as clean as possible, but I don't think we should write these sources off just because they produce carbon emissions. But putting that aside, just looking at what Germany did, it's like we have the playbook here. It does not end well.
Yeah, 100%. Yeah. And then, I mean, that we talked earlier about wind's capacity factor is 30% of the year, roughly. That's the number of megawatt hours you get for every 1 megawatt of installed wind. Solar is even worse. It's about 20%, 15 to 20%, depending on how strong the photovoltaics are. And so, yeah, you can double or triple the installed capacity of renewable generators, but because they're not generating when there's peak demand, because they don't have the ability to ramp up production in response to peak demand.
And it should be common sense. Like when does peak demand come? When it's really hot. Why is it really hot? Part of the reason is the wind isn't blowing. And the other end of the spectrum is when it's really cold. And why is it really cold? Is because the clouds are blocking the sun. It's like
right, yeah, and I mean, wind in particular is really quite a. I've gone as far as to say that wind power is poison for an electrical grid. Maybe a little extreme. If there's enough batteries, it would be okay. But if you look at a wind production curve, it peaks in the middle of the night when no one is using it, and it declines to its lowest output level at the hottest part of the day. And every record power price day we had in ERCOT last summer was a low wind day. People don't even look at load as the driving factor for peak pricing. They look at a metric called net load, which is load minus renewables. And so you could have a really hot day and a ton of demand on the system. But if the wind is blowing, you're going to be okay. You know when the solar's going to be generating, and if the wind is blowing, you'll be okay. If there's no wind, it could not even be necessarily that hot of a day, and you'll have $5,000 megawatt hour pricing. And it's the electricity consumption peak every day of the summer happens at the same time. It is between 4 and 5 p.m. That is always when demand is peaking, because the sun's been going ripping away for a long period of the day. It finally starts to decline, and now it is like it's following a clock. 5 p.m., power demand starts to drop off as it starts to cool down because the sun is less intense. And that used to be the highest price point of the day. It makes sense. That's the hottest. That's when power demand is the highest. That should be the highest price. The demand for the good is highest, so that would be when the price is high. And power, of course, is extremely temporally sensitive. It's a different price every 5 minutes in ERCOT. Now, because of the prevalence of solar, the actual price peak has shifted out by over 2 hours. So it's no longer 4 to 5 p.m. It's now 7 to 8 p.m. 7 to 10 p.m. is where you have peak pricing because the sun has gone down. And almost every day like a clock, 7 to 10. This past August, a little bit of June, some of July and September, the prices were at administrative caps of $5,000. So you've, through this price distorting and market distorting signal of production tax credit, we've actually shifted the peak price of power out to a vector that is no longer consistent where there's peak demand.
Not ideal.
Not ideal. Not ideal.
So how do you square that? I think Cormint, you guys are using wind. West Texas is the future of energy grids everywhere. Mm-hmm. Is this just an anomalous, awkward period where we're figuring out how to use this, or is this simply pure central planning corruption that needs to be fixed?
I see both sides, and I love renewable energy. My business is economically viable and profitable because of this price distortion. And we are following the price signals that our centrally planning overlords are telling us to follow. And our load being where it is contributing to the demand to build more of these projects. And so, in a way, this cheap energy is creating a flourishing economic environment for the Bitcoin community in West Texas, it's what's happening there right now, which is kind of cool. And I also think another really unique thing about it is that Bitcoiners are the only people who are, not the only people, but they are consistently among the ranks people who regularly tell the truth about power markets. Like everything else that Bitcoiners touch, they rapidly devour the available information. They learn entirely new disciplines, and they become extremely educated on all of the contributing factors to whatever situation is going on, whether it's distributed systems, engineering, the history of money, the history of various schools of economic thought, cryptography, chip fabrication, chip manufacturing, silicon, all of these disciplines, Bitcoiners, they learn about them. They start sharing their reactions to these ideas and how they interplay with Bitcoin. And then you listen to a Bitcoiner talk about one of those things. Like, that guy's one of probably the smartest people in the world on that particular thing. And now we see all these Bitcoiners who are really smart about power. They're just going in and trying to tell the truth. Cormint does not necessarily have a dog in the fight. We're taking advantage of the current distorted market. We're consuming lots of cheap power. We're profitably converting it into Bitcoin. And I would say a second derivative of, yes, we don't have a dog in the fight. We're not going to tell you we want this generation type over that generation type. All we want is cheap generation. We want the cheapest possible generation. As a second derivative of that, we become stakeholders in wherever we are situated jurisdictionally. Like, I have enormous exposure. Every employee of my company, every executive has enormous exposure to the reliability of the Texas grid, the cost of the Texas grid, and the overall well-being of our electricity marketplace as an orderly and functioning place to do business. And so you get this second derivative where educated, open-minded, and unbiased Bitcoiners come in and tell the truth about this stuff. And I really don't think it's a coincidence that every Bitcoiner resoundingly says the same exact thing. We have to nuclearize the entire economy. And it's almost like the opposite of a politician, where there is no NIMBY. There's none of that. It's just unadulterated truth. And if you contrast that with a politician, you have this rabid voter base who's hysterical about carbon, and they're paving themselves to roads and throwing oil on paintings, and being hysterical. They're single issue voters on climate. It is what it is, right or wrong, true or not. It is what it is. Getting elected requires pandering to those voters, and you can see that in the Venn diagram of, I'm doing something about decarbonizing the economy and ideal policy in terms of gonna get me reelected. Nuclear is not in the middle of that Venn diagram, because nuclear pisses people off. People don't want nuke plants in their backyard. They're not educated about nuclear safety and the improvements in the industry. And so building a bunch of dumb wind turbines, building too many wind turbines and solar panels that create a massive distortion in power markets, raise prices, and reduce reliability, that ends up being the Venn diagram place where you can appear to be doing something. It's going to be enough for 4 years to get you reelected, and you're not actually a long-term stakeholder in what you're doing. It's really bad politics. And I don't know how it's going to change. I don't know who's going to be the nuclear renaissance man. Nobody listens to Bitcoiners anyway, so
They should start. I think we just need to start buying these assets. It's happening too. I've seen it.
It's one
across the U.S. People are buying coal plants. People are buying nat gas generation.
Yeah. Building a nuke plant's one of my long-term goals.
Yeah. It's a virtuous goal to strive for. Thank you for striving for it.
It's hard. I mean, they don't make it easy.
Yeah.
Every engineering decision in a nuke plant gets 10x the scrutiny of a solar plant.
Well, I spoke with somebody who runs a nuclear power plant in Nebraska a couple of weeks ago, and they have this exact problem. They were overbuilding wind specifically, and then I think 20% of the year the nuke plant has negative pricing, and they just had to eat that, because that's the other thing where the pricing corruption due to the subsidies comes in. Is nuke plants, you can't just spin them up and down.
Yeah,
like you have to keep them on.
Yep.
And so these plants have to eat that negative pricing when it comes, and it's becoming longer periods of time throughout the year as these subsidies incentivize all this unreliable generation.
Yeah, it is a truly distorting price signal, because it is actively disincentivizing the type of generation that the grid needs to at least maintain reliability or improve it.
Bitcoin fixes this. Just fucking put 100 megawatts of a mining operation behind the meter.
Right.
Give the finger to the wind farms when the negative pricing comes. Say, hey, we're producing revenue anyway.
Definitely. Yeah. It fits so well with reliable generation and avoiding negative prices.
Yeah.
Especially like the crappier rigs.
Yeah. And luckily it does seem like the Bitcoin mining industry is becoming more smart about this, particularly behind the meter. To date, it's been a lot of front of the meter.
Right.
Basically getting electricity from a substation that's connected to its transmission line. I think a lot of people in the industry are like, all right, how do we get closer to the source? Let's go to the power facility and get to the point before it even goes through the transmission line.
Yeah, you do avoid a bunch of transmission costs. If you do that in ERCOT, you can get a nodal price instead of a zonal price, and nodal prices tend to be lower than zonal prices, because every power generation facility in ERCOT has a node. It has its own pricing point on the grid, and every load on ERCOT has they don't have a specific nodal location. It gets blended into what's called the load zone, and inside of the load zone, all transmission charges to route power to different users throughout the grid are basically aggregated and then averaged and split across all consumers. So in the West load zone right now, because there's a lot of Bitcoin miners popping up, there's a lot of renewable generators popping up, and things are growing and moving pretty fast out there, the transmission cost to serve loads that are isolated specifically in the far west of Texas are really, really high. And so those costs then get subsidized across the entire load zone, because what they don't want, and it does make sense, is they don't want a particular load in a very remote corner of the grid to have to pay 10 times the cost of every other load in the grid. For generators, they're willing to do that, and they want to incentivize generation to go in the right places on the grid. But for load, there's very little tolerance for a particular electrical load to pay a drastically higher price. And so the cost to serve that load is set by the market and by the generators, and then it's averaged across everybody else. And as a result, the additional transmission charges to those loads that are in very remote places, they end up driving up the average price everywhere else. If you are behind the meter next to your own generator, you avoid all those charges. And in the summertime, when the entire generation fleet is ripping, these transmission charges are relatively low. It's called congestion or basis. But as soon as the weather cools down and the system has much less load on it, so starting in October and basically going through May, the basis has been averaging over $10 a megawatt hour. So you're paying a full penny higher during those outside months. So if you co-locate with a generator and just do a direct agreement with them, you get that generator pricing. And it is a huge advantage. It's another reason why the energy community should move close to the Bitcoin community, because the same thing could happen to them. Like if you have a power generation node that's in the middle of 25 wind farms, you're going to get the lowest prices on the grid for your power, because you're producing power in a place where there is no user. There are not very many users of the power. If you just bring in a Bitcoin mining load, you're like, well, cool. I'm out of that now. I got my own little guy right here, and he just takes all the power I can give him.
And it seems like Bitcoin adoption's picking up. The price is going up. That's another thing heading into the halving, which is less than 10,000 blocks away after this weekend.
Don't remind me.
But it is an interesting dynamic heading into the halving if this price appreciation continues leading into it. Seems like a very unique dynamic that hasn't existed in a pre-halving market today.
Yeah, we've got rapidly rising difficulty. We've got rapidly rising price.
Right there. Just now.
What?
50K.
50K. Yeah.
50K.
Congratulations. Let's go.
We're at 50K.
So we haven't been above 50,000 since, I think, April of 2022. Or was it 2021?
I think it was like, no, because we peaked in November 21.
We peaked in just below 70 in November, and then we stayed around. It might have been between. Yeah, it's been a while.
Yeah.
Welcome back, boys. Let's go. Cool.
Yeah.
Exciting.
Price is ripping, but as you said, hash rates absolutely screaming right now.
Yep. And fees. We've had a couple of periods where fees have been surprisingly high too. So it's been a wild time.
Yeah. So what are you worried about heading into the halving?
I think the thing I'm most interested to see is what kind of difficulty adjustment happens after the halving. Seems like there's a huge range of predictions. And did you ever read the Coin Metrics report called The Signal and the Nonce?
Yeah, did Kareem write that?
I think so, but I'm not 100% sure. But effectively what they did was they used nonce patterns in the machines that make up the majority of...
Yeah, you can essentially reverse engineer which machine is producing which nonce.
Exactly.
And so you can use the chain data to get a landscape of the inventory of machines that are being used.
Exactly.
At any given point in time.
And so you look at that report. It was released at the end of 2022. I'm not sure when the data set they used was, but as of the end of 2022, 60% of the network was S19, M30s, or lower efficiency machines. So right around 30 to 35 joules per T. And just looking at the break evens of that equipment and where we are today, I think as the next difficulty adjustment is projected to be 9%. Yeah. And
Logan, look up the estimated hash rate on mempool. That space. It's above 600 now.
It'll be above 600 with that adjustment. And the break even, now Bitcoin keeps ripping, so this information may be stale. But let's say that after this 10% difficulty adjustment, and given the fact that we just probably rallied 10% over the last 6 or 7 days, the break evens there are in the high 70s, mid to high 70s.
691.
691.
24-hour estimate. So
yeah,
take that with a small grain of salt.
Right. So you have break evens in the mid to high 70s right now, and halving are going to bring that to. The halving is going to bring that to $37 a megawatt hour, $37 to $39 a megawatt hour. Not a lot of people who have power costs that is below, all-in power costs that are below $37 a megawatt hour.
No, it's 3.7 cents a kilowatt hour for anybody out there.
And so I'm a big believer that we're going to have adjustments. We're going to have material downside difficulty adjustments in April and May. And in previous cycles, one stat I've been seeing a bunch thrown around is the number of days it has taken historically post-halving for hash rate to recover to its previous value immediately prior to the halving. And it's been the last two halvings were between 30 and 70 days that hash rate fully recovered. But now we have so much of the hash rate is in ERCOT, and so you have April 20th halving projection date, you have May, and then we immediately start the Texas summer, where last summer, during a Bitcoin bull market, or a little bit of an upward momentum market, difficulty barely adjusted at all through the entirety of the June 15th through September 15th period.
Because miners were participating in demand response.
Yeah, because there was active curtailment, and there was demand response, which was curtailing miners, and it was a pretty hot summer everywhere. So that was every northern hemisphere grid, and ERCOT obviously being the biggest one with a very, very high electricity price summer. So I think we could see that hash rate does not fully recover until
Fall.
October.
Yeah.
October would be my prediction for when hash rate is going to recover to its previous level from before the halving, with the caveat that if Bitcoin just goes on an absolute heater throughout the rest of the year, all bets are off.
Yeah. We run to if Samson Mouse, we run to 100K before the halving happens. That helps a lot of things.
That would be wild.
But then you have this dynamic too, two dynamics at play where the S21s are coming to market. It seems like Bitmain's going to be able to produce a lot of them month in and month out, between 50 and 100,000 per month. Most efficient, highest hashing machines that we've ever seen. They have a hydro unit, which is even more efficient, higher hashing, which opens up.
Are a lot of people buying those hydros?
I'm not sure.
Yeah, me neither. Sorry to interrupt you.
No, I'm not sure. But we had that dynamic coming. And it seems like they're already being plugged in, which I would imagine a lot of the hash rate growth that we've seen over the last few weeks is 21s getting plugged in. And then you have
slug of 21s.
Then you have this confluence of events where the international markets seem to be seeing what's going on here in Texas and begin to get into the hash race, if you will.
Yeah, for sure. The other thing about the S21s is the research that's coming out on them is they're very thermally sensitive. So that hash rate will also be restricted
in
quite
the
a
summer.
bit during the summer.
Yeah.
Yeah, so it could all come online, and then there could be a big adjustment from lower uptime, all of those S19s and M30s going offline, a lot of curtailment for power optimization. It's going to be interesting.
A lot of them will be in low power mode throughout the summer.
Oh, yeah.
Which they've made easy with this model.
Oh, they did?
Yes.
Oh, good. So you don't need as much the third-party firmwares?
No, you probably would benefit from it because you can probably get more modular with what you want to do, but they do have stock power mode, high power mode, and low power mode.
Do they have a curtailment function that's good?
I doubt it. I'm not sure.
It's wild, man.
Yeah.
Man, is there any other industry where the manufacturer of a good
just
has
hates us,
such disdain for their customer base and regularly mistreats them, and there's very little consequences?
Well, there's only two, really one. Maybe we can call it a duopoly, but it's trending towards a monopoly.
Right. I have heard good things about Auradine. Auradine is
they're the ones that did they basically had their ASIC at the North American Bitcoin Conference. Is that when they released it?
I don't remember seeing them there, but I'm sure that they did. Marathon disclosed a seed investment in them early on, and they're now releasing their first ASICs, and they're good, and they have the functionality that a Texas-based Bitcoin miner would care about. Yeah. They can underclock, they can overclock, they curtail really quickly, and you don't need to use third-party firmware. It's all built right into the miner firmware, the stock firmware, and it's a great toolkit.
Yeah, so let's dive into this a little more for anybody who may be ignorant to this dynamic in the mining industry, which is you have these machines. You get them from the manufacturer. The manufacturer has a firmware that basically runs the machines. But miners, particularly in ERCOT, need to do more with their machines, particularly if they want to participate in demand response. And mainly, they need to be able to turn down very quickly, which the stock firmware does not enable. And so you have to go to third-party firmware services that essentially jailbreak the firmware on your ASIC, inject their own firmware that can then communicate with the pricing API to do all this in an efficient manner.
Yeah. And the core features that you would want. Well, take a step back. You sort of have two main categories of functionality. You have performance, meaning how many watts can I run through my chip, and the more watts that I run through my chip, I may lose efficiency a little bit, but I'm going to get more Bitcoin out of it because I'm going to be submitting more valid shares to a pool. I'm going to be attempting more solutions at a successfully mined block. Then you have a separate functionality, which is the ability to respond to either a signal, which is called a base point, or a frequency base point from the grid operator, which will say, hey, I need you to set your machine to this. And you have to respond to that quickly. Or you're responding to a free market power price input, or the ERCOT pricing API prices every 5 minutes. You respond to that data, and then you power down the miner or continue mining based on that price input. So neither of those functionalities comes out of the box with the existing ASIC manufacturers that you would know. And so, like you said, these third-party firmwares effectively jailbreak the miner, and they allow a non-manufacturer firmware to run on top of it. And these firmwares are great, and they're way better. And on the overclocking and underclocking side, it's not really surprising that the ASIC manufacturers aren't thinking like this. Maybe because they're not really mining that much, maybe because they don't focus as much on cooling, but cooling is so important. It is the name of the game. This is why immersion and hydro, why immersion is sort of dominating now in terms of performance, and hydro is the next level of it. Immersion is your miners are submerged in an oil bath, and it becomes a fluid dynamics equation instead of an aerodynamics equation. So you're just constantly pumping oil that is colder than the chips through the miners, because the oil is coating 100% of the surface area of the chips instead of air, which is not hitting anywhere near 100% of the chips. You're able to dissipate more heat off of the chip into the fluid. Then the fluid is exhausted outside of the tub that the miners are sitting in, and it's put through some kind of radiator, dry cooler, heat exchanger type of thing, and it's a constant loop. So you have a big plumbing equation, you have a big fluid dynamics equation, and that helps you draw more heat off the chips. The reason why that's important is because the ideal operating temperature of a chip is 60 degrees Celsius plus or minus, and then you can run a ton of wattage through a chip, way more than its standard operating spec, as long as the chip stays at 60 C. It's not going to cause any harm to it. So these things are incredibly robust. And there's no other, the reason why the ASIC manufacturers maybe aren't that clued into this, or they don't care, is because there's no other computing industry that treats a computer like a Corvette, where they're just like, dump the fuel in, let's go. We want to get as many horsepower out of this thing as possible, and as many RPMs as possible, because it's a vanity engine. Bitcoin mining is effectively like that, because each incremental watt of electricity you push through gets you an incremental quantity of sats, or fractions of a sat, in the case of a watt. And so you have this big thermal optimization. What that ends up looking like in Texas, if you have a good cooling system, is you're able to overclock your machines sometimes as much as 20 or 30% in the winter when the ambient temperature is cold enough. And in the summertime, you actually have to do the opposite. Like, we're out in the West Texas desert. It gets well above 100 degrees almost every summer day. And so the thermal, the cooling capacity, thermally speaking, of our cooling system, which is normally very good at dissipating heat, it actually is reduced because the containers are hotter, the air outside that you're using to cool the fluid is hotter, everything is hotter. And so you have to reduce the amount of wattage that you're pushing through the machine in order to target that 60 degrees Celsius temperature. And so what this company Auradine has done really well from what we understand. We haven't tested them yet, but we've talked to enough smart guys who we trust that have tested them, is they allow you to tune the miner voltage and frequency up, which gets you a different wattage draw from the stock setting. You can go way down. And when you do that, you drastically improve the efficiency of the machine. You can also go way up and you decrease the efficiency of the machine. And the reason why that's important is because if power is zero, if the cost of electricity is zero, you want to push as many watts through your mining machine as humanly possible, because you don't particularly care if your machine goes from 28 joules a terahash efficiency to 36 joules a terahash. You don't really care because the input cost of that power is zero. And, in Texas, we have 10% of the year that's negative pricing. We have $0 pricing for electricity all the time. So these Auradine guys have made a miner that is very well fit for an electricity market like Texas that has a lot of zero pricing and has a lot of very high pricing. You can get paid a lot to curtail. And so this is like what the miner firmware of the future should look like. And by the way, firmware is expensive. I mean, you pay 1% to 2% of your revenue for firmware. So it's a huge cost savings to buy from them.
Mm-hmm. And how big of a splash are they make in the market? Like, how many machines can they produce?
Yeah, I mean, it's starting an ASIC company is really tricky because...
Yeah, that's the thing I worry about most. It's
extremely
capital intensive, takes a long amount of time. Mm-hmm. And that time, well, that's... maybe we're hitting an inflection point where the time aspect is not as important as it was in the past, where you'd have these large jumps from 7 nanometer to 5 nanometer to 3 nanometer. We're literally reaching physical limits on these chips that you're likely not going to have the step function improvement at the chip level that has existed in the past. So the concept of ASIC commodification has been talked a lot in the mining community over the last 5 years. And if we're getting close to that point, maybe the barrier to entry for a new ASIC manufacturer is a bit lower.
I do agree with that. I still think that it's very hard.
Yeah.
Simply because from the perspective of an operator, we probably are picking the machine that we're going to run 6 months out from when we run it, or when we even buy it. So you're thinking about what's the form factor of this machine, what's the availability of this machine from a pricing perspective, and is it going to function the way that I believe? There have been historically, even with Bitmain, the S17 had a failure rate.
Bad epoxy.
The heat sinks were falling off. You had a massive failure rate on that. So there's even risk with the existing manufacturers. Then what was that one that kind of looked like Mountain Dew?
New Miner or something like that?
New Miner. That had a 50% failure rate. And people who bought those...
got wrecked. And you get back Dragon Mints. Down the line.
Dragon Mints. So there's a huge risk in buying the first batch of ASICs from a brand new manufacturer. And if you're designing for a particular ASIC, you have to really commit to it. And so as a premise, it should trade it at a discount to a Bitmain or a MicroBT. Even MicroBT trades at a slight discount to Bitmain still and it's been around for 5 years. And so if you're going to be a new ASIC manufacturer, you need to price at a 25% discount to the market in order to compensate your customers for taking a risk on a new batch. And then that gets better and better and better as time goes on. But it's one part ASIC commodification and reaching the state of the art in the chip industry. And then that's the other part, consumer mindset and consumer psychology of taking that risk. It's not a risk to be taken lightly. If you're a miner, you could literally lose your whole business.
Yeah. No, that's the other thing, leaning into like ASIC commodification. And we've talked about this on Peter's podcast, but it's worth repeating. Like even within Bitmain alone, like the PSUs, like the power supply units that literally allow you to plug your machine into a wall, like they're not uniform across every model.
Right.
And that blows my mind. It's like, how have we not gotten to a point where it's like you can get an order and expect a certain PSU.
Right.
Like, even between like different XP batches have different PSUs.
Remember when they made one version of the J Pro like 2 inches longer than the previous one?
Yeah.
And it caught everyone off guard.
Yeah, it fucked up all their heat circulation.
Right. I mean, if you're running immersion, 2 inches is a lot.
Yeah.
That's, you design an immersion tank
Based off the form factor specs.
Exactly, because you need to have uniform flow rate and flow distribution of the fluid through all of the miners. And so little changes to the form factor
fuck up the physics.
It could totally screw up your entire cooling system.
Yeah.
If you're trying to be extremely efficient with fluid.
We're so early. Like that, it's like, because we were in, you were in Nashville. No, were you?
No, I didn't go to that one.
We were talking to.
I'll be there for Bitcoin conference though.
There was at the Energy and Mining Summit Nashville last month, there was incumbent data center guys that are getting into Bitcoin mining, and that was like their one like piece of feedback was like, I can't believe that none of this is uniform yet. Like this is such slapdick activity. The fact that you guys put up with any of this is insane.
I know. It's Bitcoin miners are just rabid, risk-on consumers.
Yeah, it is the wild. It's like a digital wildcatting.
Yeah,
to an extent.
Plus, you really don't have much recourse. It's a Chinese vendor, and they send you something. You got to plug it in no matter what. You got a year. The first 3 months are critical in a rising difficulty environment, and it's. Yeah, I mean, an American ASIC manufacturer would be great.
Yes.
I could see, actually talked to some folks about this, and it almost got off the ground, but it didn't. A cooperative, an American-based ASIC cooperative, where a couple of really good chip guys got together and started a non-profit cooperative where you put a little bit in for the IP and the tape out and all of that, just to get the process rolling. And then everybody got a machine at cost. So you bought the fab time, the foundry time, you got paid back in ASICs. And you look what happened with the Intel ASIC. It was a first iteration at that with a reputable chip manufacturer, and that did not work out well for the firms who participated in that.
No.
History has been really unkind to people who take incremental risk in Bitcoin mining. Whether it's incremental financial risk, like taking on USD debt, getting into anything upstream in manufacturing the ASICs, trying a brand new ASIC manufacturer, buying their equipment for the first time, control boards, even power supplies. It's
building your own data centers.
That risk, I think you need to take. I think you need to take the risk of building your own data centers, and I think you need to take the risk of getting as close to the wholesale market of electricity generation on power side. Those risks are, you can control them really well. They do require investment, but you can control them much better.
Yeah.
Because think about it, if you rely on a third-party equipment vendor for your data center infrastructure, that's also a risk.
Yes.
As we know.
But then you have to weigh the risk of the time. Because like going back to that's the name of the game. And I think, again, the whole industry has been going through this iterative process, and that's one thing that encourages me this cycle. It seems that the industry is getting smarter about when they purchase the ASICs and where they are in terms of infrastructure build out with those buys. Because you want to buy those ASICs, get them delivered, and plug them in.
Immediately.
Yeah. Which last cycle was not happening.
Right. And it's still happening today.
Yeah.
I mean,
rack space is scarcer than Bitcoin, it seems, right now.
Is it?
It was for a while. Right now, I think
I'm not in the market, so I don't know.
I think the market is responding, but
yeah, we don't have.
There was a time in 21, 22 where after the Chinese migration, people are like, yeah, we'll take your ASICs, we'll plug them in. They're like, oh shit, we have nowhere to plug them in.
Yeah, I know that the ASIC manufacturers. We're doing a lot of hosting deals, trying to get XPs plugged in. We don't host. One of the coolest things about our company is we have no customers.
It's a lot less stress.
My last business, we had a lot of customers, and my two business partners in that company, they love that about this business. Technically, we do have a customer. It's an algorithm. Mm-hmm. Our customer is a distributed
Hashcash SHA-256.
Yeah, it's a distributed computer algorithm.
That's technically that's a customer of the Bitcoin network looking to. Yeah. Transactors are your customers.
They are, but also just the Bitcoin code.
Yeah.
That's where the vast majority of our revenue comes from, is the distribution schedule of the original algorithm.
Yeah.
And then there are some incremental people doing God's work and paying me fees, paying us fees. And yeah, I mean, I'm the king of controversy on this topic because I like fees, but
I like fees too.
All right. I'm very indiscriminate about fees. I want anybody who wants to pay me fees to be able to do so. One of the things I think that's going to be the coolest development over the next 10 years is if we assume that fee markets are going to materialize and become the majority of contribution to mining revenue versus the way they are now, where the subsidy is. I mean, in this block era, I think it's averaged 1 to 20 subsidy versus fees, maybe 1 to 17. When we have, it's going to be 1 to 10. Then we have in 2028, it's going to be 1 to 5. If fees continue to grow, you could see an entire block epic to be parity between fees and subsidy in the 1.6 block reward era, 1.5 and change, whatever it's going to be in 2028 to 2032. But what should happen, or what I predict will happen, that's going to be really interesting, is the block times are going to be much slower during periods of peak demand. That phenomenon is going to accelerate. Like in the Texas summer, block times are they don't grow at as consistent of a rate as they do during the non-summer months in Texas. And you're actually going to see that more intraday, where, like, let's say it'll be an afternoon period. Block times will start to slow as all the miners begin curtailing. That will have a reflexive effect where the fee market starts to jump up. And then you'll see this inverse correlation between LMPs and fee markets, where the fees could rise up so much that it actually pushes the LMP of electricity to become attractive to mine. So all this hash rate will come online in response to the rising fee market. So you'll have this like crazy interplay between.
But you imagine over time it'll start like this, but it'll eventually get to like poof.
Yeah, it will eventually become very efficient, but I think you could start to see a long-term trend where off-peak electricity has materially faster block times over a period of entire year than on-peak electricity.
What was once the BitMEX payout fee spike will turn into the energy price volatility and curtailment.
Yeah, this
fee spike.
Elegant intersection of fees and LMPs.
Yeah, for those that are unaware, like BitMEX, they would do it every Monday morning at 9 a.m. they do payouts or something like that.
I believe that's correct.
And you could visibly see it on the chain. It's like, fees are up. Right. BitMEX is paying out all their users.
Yep. I was thinking about that, how far we've come since that March 2020 BitMEX flash crash.
A lot has happened.
Yeah.
Turn the engines off.
It was crazy to think that Bitcoin almost, BitMEX was the dominant exchange in terms of liquidity in March of 2020, and they only accepted Bitcoin as collateral, and blocks were full, fees were through the roof, Bitcoin crashed over 50% in like a couple of hours.
Overnight.
It was trading 8,000 on whatever the overnight 11th period. Yes, right around there. It's trading 8,000, and within a few hours, it was trading 3,300. And so nobody could get additional collateral into BitMEX because the blocks were so full and the fees were so high.
Some of them were cheaping out.
And all of the collateral that was on there, which was supporting Bitcoin long positions, like if you wanted to buy Bitcoin on BitMEX during that time, you could only post Bitcoin as margin collateral. So your margin collateral was crashing in value. Nobody could get additional margin collateral in there, so everyone was getting liquidated. And then Arthur just pulled the plug. There was definitely a meeting after that. We're like, all right, guys, you guys are done. Yeah. You have to have a US dollar.
I mean, I know people who were running funds that were basically trading on BitMEX.
Right.
And they didn't put a high enough fee on their transaction and could not meet their collateral call.
That was probably the sickest buying opportunity in the history of Bitcoin.
Yes.
In terms of what was going on in the backdrop from a macroeconomic perspective, with money printing and all that. And
leading
then
up to a halving.
Into a halving, yeah, exactly, into a halving, and you got an opportunity to buy Bitcoin at $3,500 a coin last time. So
Parker and I recorded a podcast with Kyle Bass from Heyman Capital, literally 5 p.m. before all of this happened. And I think the last question I asked Parker is like, what's going to happen with Bitcoin? He's like, I don't know. Just make sure you have your coins in self-custody.
Yep.
Thank God for Satoshi. And I stayed up that night. I was like smash buying throughout the night. I was like, oh shit, 5,000, 3,500, like boop.
Yep. I bought a bunch too.
Yeah.
It was good. And then people got stimulus.
Yep.
So everybody could roll their stimmies into Bitcoin.
Yeah. It's a crazy time.
It was. And then a year later, meme stock with deep fucking value.
Deep value.
AMC, GameStop.
Did you watch Dumb Money yet?
No, is that the...
It's a movie on it.
Oh.
It's pretty good.
That was one of the funniest, most fun times of my life. I remember every day just getting up and just like seeing the moves in the markets and the memes flying around on Twitter.
The meme culture around that time, I think, I don't want to say it peaked. Maybe we can get to that level again, but that is the last all-time high in meme culture. It's around there.
I'm a big meme culture guy.
Same. It's good for the soul.
It is.
And it's actually, we laugh about it, but I do think it is one of the most potent tools we have to take away power from these people who probably do not deserve it. You need to ridicule these people. Memes are the most effective way at ridiculing these people.
They definitely are, yeah. And there's nothing that ridicules them more than cryptocurrencies based on memes of dogs speaking broken English that are worth tens of billions of dollars.
Is this Bonk?
No, I don't think Bonk is worth tens. Doge is worth 10 billion.
Oh, Doge.
Yeah. Yeah, I mean, there's 3 dog coins that are worth more than $1 billion.
Bitcoin's worth more than $1 trillion now.
Bitcoin's worth more than $1 trillion, and guess what? Even our little dog coins are
worth more than $1 billion.
They're worth more than $1 billion.
Where do you think this all goes? Are you optimistic? Cautiously optimistic? Everything. Bitcoin, mining.
Yeah, I'm so optimistic. I'm blinded.
I have this long-running belief that's becoming more hardened by the day, such as an order of operations to the success of Bitcoin, and the front end of the order of operations lies in the hands of the mining industry and convincing the energy sector, like, do this.
Right.
And I've become extremely more hardened in that belief and more optimistic as time goes on. Even though there's still a disconnect and not everybody gets it, I think people like you paving the way and others in the energy sector beginning to have the light bulb go off is creating the environment where it can really have this escape velocity in terms of the acceptance of Bitcoin outside of this bubble that we've been in. Definitely.
Yeah, I mean, so we launched our flagship financial product last year, which is our Bitcoin denominated bond.
Yes.
And We raised just under 1,000 Bitcoin. It was a Reg D 506C offering, which is an SEC registered offering for accredited investors only. The only way you can do lending products with retail is if they're callable, and if you have a callable loan, that's how you have an asset and liability duration mismatch, like Celsius and BlockFi had. But so we launched this product. The Bitcoin community liked it a lot. We did it on pretty good terms. It was a venture debt, so you got a bunch of warrants in our company, and you get a 10% yield on Bitcoin, and you're at the top of our capital stack. You're first lien over all the assets of the company. And, the way to think about this is we're taking this Bitcoin, we're turning it into the machines that create Bitcoin, and it's a very secure form of commodity production finance. It's like borrowing barrels of oil to go and build an oil drilling site and to pay your leases and get your drill rig all set up. And so there's nothing like it in commodity production finance, because obviously oil is not transportable. There's tremendous storage costs. There's gravity differentials between different types of oil. It's not a fungible commodity. And natural gas, same thing, doesn't work. You could do it with gold. I'm surprised it never existed in gold, but I know it is what it is.
It comes with pretty high storage costs.
Yeah, high storage costs too, absolutely. But Bitcoin is, it's a monetary commodity. It's instantly transportable. It's fungible. There's zero friction in it, and so it is a perfect method of commodity production finance. And where I'm going with this shill of my company's.
I'm happy you brought it up, because that's what I wanted to end with. Is this?
Okay, good. But here's our kind of big thesis on it, and I tell this to people, and they say like, "All right, cool, buddy." Is like we said before, Cormint has no customers. Our customer is a distributed algorithm, a distributed software platform, and occasionally it is individuals who want to pay fees. It's 5% individuals and firms paying fees, 95% a software algorithm. That software algorithm is the single largest non-state buyer of electricity in the entire world, and growing at 15 gigawatts,
approaching 700 exahash.
Yeah, 95% uptime times 16 gigawatts. It's the single largest buyer and most consistent buyer of electricity in the entire world. Bitcoin denominated finance, power plants together. If you're converting energy into Bitcoins, Bitcoin should be the financing instrument for power plants, and you get those two things together. Now, admittedly, right now there's obvious reasons why this is not happening. The halving is one of them, because a power plant amortization schedule, meaning you invest X in CapEx, you expect to get your CapEx back in Y years. Y years is about 10 years. And you're going to have, depending if you time the cycles perfectly, you're going to have 2 halvings during that 10-year period. You might even have 3 if you screwed up, I think. And so if you take a bunch of Bitcoin and use it to buy a power plant and then plug in miners and go through the whole cycle there during that period, your Bitcoin denominated revenue is going to go down pretty materially per unit of hash rate during that time period. And so it becomes hard to align the amortization schedules of the power plant with the mining operation. Dogecoin has no halving, so it's actually, you could probably finance a power plant with Dogecoin. Dogecoin denominated debt, FYI, just Doge shill. But obviously the Doge market cap is immaterial, and it's a significantly worse store value than Bitcoin because it has perpetual issuance because there are no halvings. But what's really cool about Bitcoin is that in that world where the fee pressure and the fees rise to be more than the subsidy, it mitigates the effect of the halving successively. And so I think then my big prediction in the next decade is people will start to use a little bit of Bitcoin in their cap stack You would be crazy to not have a power plant, a Bitcoin mine, a little bit of Bitcoin denominated debt, a little bit of USD equity, a little bit of USD debt. Like that's what the right cap structure looks like. Then you have an indiscriminate buyer of energy. You can sell that energy back to the grid anytime you want. If Bitcoin flies around and there's a bunch of volatility, your Bitcoin denominated financing piece protects you from that. And the revenues, in a period where your Bitcoin mining revenue goes down, expressed in dollars per megawatt hour, your opportunity to optimize power and sell it back to the grid goes up. The more that the Bitcoin break even goes lower and lower, the more that you would be curtailing your Bitcoin mining load and selling the power back to the grid. So the interaction of these markets where you have a flexible generation stack and a flexible Bitcoin mining stack that also has that fee pressure dynamic, with block times getting slower, it just all it fits together so elegantly. And that's my big prediction. That's my crazy prediction is Bitcoin denominated finance for power generation becomes a thing.
I don't think it's that crazy.
Yeah, I know,
I think
but
it's a good idea.
You're on the absolute fringe of
this is how we get to a type 1 civilization. Like you need these types of, and again, going back to like the first order of operations in the energy sector being so important, like that's the big question. Is like, how do you go from like a dollar reserve system to a Bitcoin reserve system? And like, this is part of that process where you basically team up.
Right.
You have two of the most important tools that humanity leverages, money and energy, team up. And then from there you can disconnect from the dollar system and begin to have the Bitcoin standard materialize.
Yeah, you have a little microgrid.
Yeah.
Where you have a community that's organized around a power plant, a Bitcoin mine, and short range transmission infrastructure. And you just have economically perfect consumption of energy. You have incentives for demand response there. I do think some of the cool things that are happening with residential demand response are another interesting step in this direction. Because right now, Texas has started to do this a little bit, but it's blown up a couple times where residential consumers could participate more directly in demand response and actively turn off their AC when power prices get high, and it would reduce their power bill dramatically. Getting the largest and most indiscriminate consumer of peak power, the residential consumer, to be more price sensitive, also is going to be an interesting restoration of free market, like real price discriminate free market consumption. Because right now it's you just get your power passed through by your retail electric provider. There's not a lot of sensitivity to when you've consumed. It's just a big blended rate that gets distributed out amongst everybody, and that's the reason why the average residential consumer in America pays 16.5 cents a kilowatt hour for power, and the wholesale market is 4 to 5 cents.
Yeah.
And they're overpaying by a factor of 3 for their power because there's no price sensitivity on that. I think that's also a cool development that plays really nicely with Bitcoin.
In terms of
the way let's say the coincidence of supply, demand, and price sensitivity all happening in electricity markets right now. Right now you have a lot of dumb electricity market participants. Not dumb, but not sophisticated, not savvy. Now you have smart home technology and that like a tech-enabled, digitally native power grid where the whole home can respond quickly. You're not like, honey, run out to the breaker in the garage and
turn it off.
Open the breaker. It's like, no, the home, all the systems are connected to a price feed, and the price feed is ingesting the real-time wholesale market electricity cost. And if you are a person who doesn't want to pay a $400 power bill in the summer, you just say, I'm willing to sweat a little bit from 4 to 6 p.m. Yeah. And that's family sauna time now.
Yeah.
We make a thing of it. Or we have a cold plunge or a cold pool in the backyard, and we'd have family pool time from 4 to 6 p.m. instead of ripping the AC at the absolute peak of transmission charges and electricity prices on the power grid.
That makes sense.
Yeah.
That would help, obviously, service demand in other areas. I'm just trying to think how Bitcoin plays into this. Like the Bitcoin miners, less incentivized.
Because the Bitcoin miners are already the inverse of the residential consumer.
Yeah.
And so what it looks like is you have a power grid that's like, it's a bit more reasonably sized. It actually works better with intermittent resource and batteries. So in the world that the Inflation Reduction Act gets renewed again and then again, and the government endlessly subsidizes the development of renewable resources and batteries, and they insist that that's the direction that the species go, at least in North America, for our energy needs, then you start to have, okay, you have Bitcoin mining, which is price sensitive, inverse of residential peak demand. You have residential demand response and participation there with a direct incentive for price sensitive electricity consumers to reduce during the peaks. And so the way it manifests is you don't have a 40,000 megawatt differential between steady state electricity demand on the grid and peak demand. You have a much narrower thing, and you have more perfect electricity markets is the way that kind of...
That's the goal.
Yeah.
You're late to your call, but...
Oh, am I?
Yeah. But I think this is a good place to end it.
That's okay.
Very optimistic.
This is a great chat.
It's always a great chat. I'm happy we're able to obviously record it with Peter, but on this show, we're able to record it. For those, Jamie and I go way back to New York. We're both New York refugees living in Texas now.
Yeah.
Your hair was much shorter back then.
Yep.
And you didn't have a beard.
I was envious of you when you moved to Texas all those years ago. It's like, man, save some for me.
Oh, you came and got yours.
I got mine. Yeah.
You came and got yours, Jamie. That is certainly clear.
Yeah. Oh yeah. Thank you very much for having me.
Well, thank you for coming. We're going to have to do this much more often. You got to come to Austin more. I know you're in West Texas.
I may actually be getting a place here.
Yeah, get a place here.
Yeah.
Come hang out here. Because I think
West Texas is great, though.
That doesn't sound that great.
I mean, isolation has its benefits.
That's true.
It's big, wide open landscape. There's a lot of liberty. Now here, feels like there's a lot more rules here than in West Texas.
Yes. A lot less rules compared to New York City, though.
That is true.
Which is the trade-off that I'm willing to make.
True. Yeah, fair enough. Good trade. But West Texas, there's some real freedom out there.
Yeah.
Let's agree to do this. Maybe you'll come west a little bit more often, and I'll come east a little more often.
We can make that agreement. I need to get out to West Texas.
Done deal. That's a deal.
That's a deal. We're going to end it on the deal. Peace and love, freaks. Sticky!